Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, the good, the bad and the ugly of tax deductions. Michael, fantastic title. What are we talking about today?
Well, Dallas, tax deductions, I just feel, is one of the areas that is the least understood area of finances.
Yep.
People say to me all the time, this is tax deductible, that's tax deductible. And they have...
As though it's an unalloyed good, as though if it's tax deductible, it must be a fantastic financial decision.
Exactly. That's what they think. So they talk about this is tax deductible, that's tax deductible.
Yeah.
And we're certainly not saying don't use tax deductions to your advantage. I mean, we talk
anyone
every single
anyone
podcast.
Who's listened to this podcast would know that no one's more into tax deductions than us.
Yeah, so the classic spaghetti western, the good, the bad, and the ugly.
Yeah,
this just came to me the other day, and I thought, gee, that fits in nicely with tax deductions, because I see there's 5 primarily good tax deductions.
Yep.
There's one that's bad, and there's one that's just plain ugly.
Yes.
So we'll go through those.
Yeah.
And have a little bit of fun with that as well.
And that's I guess as people listen to it, is what they're thinking about we may not be talking about this, but as I guess a takeaway to think about here is that, you really got to think about what is it that I'm trying to achieve, and is this expense that I'm claiming a tax option on, is it actually putting me in a better position or not? So, we might not necessarily go through every different type of tax deductible option or expense in here, but as you go to do this, that's the first thing that I want to click into people's brain, is that it's not magic. Just because you get a tax deduction for something doesn't mean that it suddenly makes it a great financial decision. So
that's right. So and I think overall I'd categorise them into 2 main things. So one is I spend $1 now.
Yeah, I get.
But it doesn't. It doesn't. I get a tax deduction now on some of that money. So some of that dollar comes back to me.
Yeah.
And that dollar is going to turn into $1.50 or $2 down the track. The bad, what I see, is someone spends $1 now to get back 39 cents.
Yep.
And that dollar disappears. Yeah. So that dollar is not turning into $2.
No.
What happens is they waste $1 to get back 39 cents or 39
exactly
cents.
Right.
So
that's probably like you say, the 2 broad categories, and we'll go through the good, the bad, and then the really ugly. But it is really that thing of, for every dollar that you're spending now, yes, you might be getting an immediate tax deduction on it, but is that dollar going to turn into $2 in 10 years' time, 20 years' time? Or is that dollar going to turn into $0
yes,
in
exactly.
10 years, 20 years' time?
So the good, first of all, I have 5 good, and the first one, contributions to superannuation. So salary sacrifices included in that, or personal contributions that you claim as a tax deduction via lodging a notice of intent to claim a tax deduction form. Everyone's familiar by now, I'm sure, with the $25,000 per person limit each year.
Yep.
So what that means is that you can put in, including what your employer puts into superannuation, up to $25,000 and claim that as a tax deduction each financial year. So if your employer is putting in $10,000 to super, using that example, an individual could put in $15,000, claim that as a tax deduction. Now, what that does is for 99% of people, barring for exceptionally high income earners, but for 99% of people, what that does is that money that they put into superannuation via salary sacrifice or via the personal contribution that they claim as a tax deduction, what happens is they ultimately put that money in, they pay 15% tax on that contribution to superannuation, but they claim a tax deduction of between 34.5% and 39%. Now, I'm using that as an average.
Yeah. And
because the average tax brackets for the average of people is between 34.5% and 39%.
Yeah, so. And that's a great point, is that obviously tax deductions are more valuable if you are paying more in tax. And that's kind of so obviously what we're talking about by its nature here is people who have a reasonably high taxable income. So if you're earning $10,000 a year, you just don't think about tax deductions because you're not paying any income tax at all. But for the average person who is working, is earning, $40, $50, $60, $70, $100,000, these are going to be of some use to you. And that's kind of what you're talking about. That's one that we talk about all the time. This is really the low-hanging fruit of just, you've got $100, you can put that into super and pay $15 tax on that, or you can keep that in your own bank account. But to keep that money, you've got to pay $34.5 or $39 tax on that. So
and the way that we like to think about that, of course, Dallas, is that if you put in $10,000 over the course of the year as a personal contribution to superannuation, and you're on a 39% tax bracket, you've already paid 39% tax on that money, income tax. You fill out your form, notice of intent to claim a tax deduction. What happens is that, rule of thumb, you get back 39% of that $10,000 that you've put in. You get back $3,900 in tax return, and only $1,500 is levied
on the way
from the superannuation fund. We call that free money. So that's the free money we're talking about. I claim it at 39%. I pay 15% tax on the way in. There's a 24% overnight return. That is just unheard of. We bang on about this one because so many people aren't doing it. And it is just such it's free money. We talk about that as we love free money. We love guaranteed returns. This is a guaranteed, in this example, a 24% guaranteed rate of return overnight just in that tax deduction or that tax difference. If I was allowed to do more and more and more of that, then I would do more and more of that.
And that's, I guess, the point at which ties into what you were saying before, is that the beauty of that is it's that you do get that immediate overnight return, but the real benefit is that what you're doing with that money is that it is going in and being invested in your superannuation fund, and it's growing for your retirement. So it's, if you had to do that to get that tax deduction, if you had to spend that money on something that wasn't going to get you a return, or if you were going to spend that money on something that you weren't focused on. But for most people who are over 50, they are focused on building up their retirement savings. And it's just free money because you go, I can then put that money in, I get an overnight return in terms of that tax deduction. And then I get that money. It's in that concessionally taxed environment and it's working for me. And that's what we're talking about, is that your dollar that you've put in is growing to $2 over time, and I've got a tax deduction on the way in. So it's the best of both worlds. And that's why this is the good, these sorts of categories.
That's right. Point two is an extrapolation on point one. So it's still a concessional contribution to superannuation. However, the legislation that has come in not so long ago, which is called carry forward concessional contributions, and what that actually allows you to do is to use any unused amounts of that $25,000 concessional cap. It allows you to go back 5 years and use any of those in one particular financial year. I'm going to give you an example in a minute. There is an anchor point there, which is the start of the 2018-19 financial year. So we're recording this in January 2021. So we're in the 2020-21 financial year. So currently, if I'm looking at a contribution using the carry forward, I can only go back to the start of 2018-19. So I'll give you the example. So this is a real life client of mine, Christine. So her and her husband sold an investment property that they've held for a long time. There's significant capital gain on that. And what had happened is that $133,906 of capital gain came coming Christine's way this particular financial year. So what's happened in 2018-19? Her employer contributions. She's actually on a low income.
Yep.
Her employer contributions were $1,739 for the year. So she has $23,261 of cap space.
Yeah.
From 2018-19 that she can use. 2019-20, $2,232 of employer contribution, so similar.
Yeah.
And for 2020-21, she's on track for about the same amount, so $2,232 of contribution. So what it actually means is that over these three financial years, 2018-19, 2019-20, and 2020-21, her employer contributions total are on track to only be $6,203.
Yep.
So she has 68. So this is a hard point to get across on a podcast. She actually has $75,000 of cap space
for those
3 years,
yep.
minus
the amount of
employer contributions that have gone in
yep.
over those 3 years. So she actually has $68,797 of available cap space.
Yep.
Now, what a capital gain is it's just assessable income. So the capital gain for her is $133,906 on top of her salary, which is about $25,000.
Yep.
So she's set to have a taxable income of some, almost $160,000 in this financial year, 2020-21, because she's got $68,797 of cap space.
She can contribute.
She can actually contribute $68,797 of money to superannuation, which we are doing. We've done that. And claim that as a tax deduction. So basically what that does is it knocks $68,797 of taxable income off the top of her income. And it's off the top, which is important too. It's not off the bottom.
Yep.
So that drops the capital gain, the tax that she's going to pay on that capital gain down significantly.
Yeah. So that's what you're saying. It's a continuation of that first strategy, which is that you can do that in every year. Everyone can do that. It's just that generally you're limited by the amount of cap space you've got available and the amount of taxable income that you have. So this is a case study here of, she's got high taxable income in this year and a significant amount of cash that they've got from the sale of that
It's
property.
a unique one because the property was owned jointly with her husband now. Yeah. Now he gets the same capital gain because he's on a much higher income.
Yeah.
We can't do this strategy because we've actually taken advantage of him putting in $25,000 every year.
Yeah.
So it was because she was on a lower income that it just didn't make sense for her to salary sacrifice to superannuation in the past or to claim any contributions as a tax deduction because her taxable income was only $25,000.
Yes.
So it doesn't suit everyone's situation.
No.
But it's a beauty for capital gains tax is one of those ones in particular that it's a really good one for.
Yeah. And that's like you're saying. The same thing applies here. The reason it's the good is that you've got that big tax bill that you're dropping right down, but that money isn't disappearing. It's going into your super fund. It's working for you behind the scenes.
That's right. So she was set to pay, let's call it 39% tax on that $68,797 of capital gain. By putting it into superannuation, she'll only pay 15% tax on that money. So point 3. So once money's gone into superannuation, there's only a 15% earnings tax on that. So here's a tax discount for people.
Yeah.
And let's use an example of like a real life figure of $100,000. So imagine you've got $100,000 of savings from the sale of a property or something like that.
Yeah.
You could actually invest that in your own name.
Yeah.
Next people, again, they're on the 34.5% to 39% marginal tax rate. So if they invest that in their own name, the returns conceptually the same rate of return that they would get inside a superannuation fund. You can invest into the same things primarily. So what we're assuming here is that the investment return is going to be the same if they invest that money in their own name, or if they'd put it into their superannuation, the investment return would be the same. The after-tax returns would be different because in their own name, that sum of money invested, they pay 34.5% to 39% on the income, not the lump sum, in each and every year over 10 years, versus if they have that money inside their superannuation fund, the tax rate is 15%. So there's another tax deduction there.
And this becomes really valuable as that figure goes up and up and up. So obviously over time we want our retirement savings to grow, and on average people come to us with about $500,000 and they're trying to get to 1.5. So when you've got $1.5 million invested for you and you know, as your retirement savings, if you assume that you 100,000, and this is all very, it's not quite this simple, but if you assume that you get $100,000 return for the year, to use those simple that comparison, if you've got $100,000 of income of a return in your own name, assuming that it all flows through in that year, which it doesn't, but forget about that for now. If that all flowed through to you in your own name and you were still working, you would likely pay at least 39% tax on that. So you'd get a $100,000 return, you would pay $39,000 in tax. Whereas if you've got that $1.5 million in your superannuation fund, invested in exactly the same way, gets a $100,000 return, you'd only pay $15,000 in tax. So once again, as those numbers go up, that gets exponentially more valuable.
Absolutely, and that's a good, perfect segue into point 4, which is franking credits. So franking credits really probably one of the other least understood.
I think we did a whole podcast on credits, didn't we?
It was called Franking Credits, not just a great racehorse name, I think it was called. Go back and have a listen to that. So I'll give you a quick explanation. So Australian companies pay tax at the rate of 30%, publicly listed companies. So if you're a shareholder of those companies, what happens is that on the profits that those companies have earned at the company level, before you've seen any capital growth or before you've seen any dividend that they pay to you, there's already been 30% tax deducted from that, and it's gone off to the ATA. You just haven't seen that. So what happens is that you get a credit for that 30% tax that's been paid. Now, a really, really simple example, we just talked about the earnings tax rate of a superannuation fund. It's 15%. If I get a $10,000 dividend from Australian companies that I own inside my super fund, I pay 15% tax. So I lose, this is a really, really simple example. It's a little bit more complicated than this, but I lose 15% tax, but I get a 30% tax credit. And that is a rebate as well.
And this was the actual, I think when we did the original podcast was when there was all the big stink about franking credits not being refundable in the future. That was what brought that to the fore. But this is the point you're making, is that it actually doesn't matter whether you have you don't need a tax income to offset that. You actually get that as a cash refund.
Yes, that's right. Exactly. So and again, if there's accountants to this or other financial advisors, this isn't the way it's calculated. And just bear in mind that I know the way that it's calculated, but I'm just trying to get the point across here. I get a dollar of dividend. I lose 15 cents because the tax rate's 15%. But I get a 30% tax credit, so it effectively turns my dollar of dividend into $1.15 after tax. So it's positively taxed environment. Franking credits is positively taxed environment. It's available for only Australian companies, so it's only for the Australian proportion of companies that you're invested into. That is not licensed to go out and buy only Australian companies. I'm not making any recommendations there. In fact, ignoring the franking credit is a very, 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 very good tax deduction. We personally, and for our clients, diversify across the board into far more things than just Australian companies.
That's, I guess, like we said, we touched on that at the start. Anytime you're talking about tax, it has to. the tax effectiveness needs to be a secondary part of the strategy. The first part of the
Yes.
strategy needs to be what is best overall, and that's a really good example of one where, being diversified across a range of different countries and economies and different companies is a safer way to invest. So you shouldn't just go, well, investing in only Australian companies is more tax effective, therefore that's what I'm going to do.
That's right. Yeah, it's a brilliant point, Dallas, because we see that people put the tax deduction side of things first in a lot of their investment decisions, or a lot of their personal decisions. So it can only be a secondary benefit, the tax side of things.
Yeah.
So it should never be the primary benefit for doing something.
Yeah.
So point 5, wrapping it all up in the good is that once you've attained the age of 60, you can and retired, either 60 and retired or age 65 and still working. Or age, we've talked about this as well. I don't want to complicate this, but age 60 and a change to you, an employment agreement has ended. Let's just call it roughly age 60, and after attaining age 60, you can actually move your superannuation from a 15% taxed environment to a 0% taxed environment. And the limit is $1.6 million per individual. So as a couple, you can effectively have up to $3.2 million in what we would just think of it as a tax-free company. So your superannuation savings, you can have up to $3.2 million as a couple. And you can effectively, the easiest way for me to get the point across here, because people get a little bit confused with this, is just imagine like you have a tax-free company. So any money that's going to make as a rate of return for you from that $3.2 million or from that up to $3.2 million as a couple is tax-free internally, and it's tax-free as an income that you draw from. So it's like having a tax-free trust or a tax-free company. Now we have an amazing system in Australia. And the amazing system is it's different from the UK. It's different from the USA. You actually get a tax deduction on the way into super, and it's tax-free on the way out if you set it up correctly. That doesn't exist anywhere else in the world. So it is amazing. So anytime people say that I guess we have a punitive tax system, that may be the case when you're paying income tax. But because we have some of the highest income tax rates. However, that's even more reason to actually use the concessional contributions to superannuation, because you can get that tax deduction on the way in, and then it's tax free on the way out. That doesn't exist anywhere else.
No, and that's I guess the point when we talk about this with every area of financial planning, is that when you do good things, you end up with easier and better decisions in future. And if you do bad things, you've only got hard choices to make later on. So when we look at the good options, the good ways to save tax here, these all flow in together really well. So in simple terms, you make that contribution into super, which is your point one. You pick up that big tax saving on the way in. Then and part two of that is you can use those carry forward contributions. You can make an even bigger contribution, pick up a bigger tax saving on the way in. Then once it's in there, you're paying 15% tax versus your marginal tax rate. So, like I say, you've made a good, smart choice. Then you've got the flow-on effect of that is also good. The return on that money, you're only paying 15% on. Then, as you touched on, if we get that money working for you, spread out across Australian companies in that case, they then come with franking credits. So that's another good part of our tax system. And then you end up with this situation where you've done the good work, you've made the smart tax effective choices here. You end up at retirement being able to take advantage of that tax free that environment in retirement where you picked up the tax savings the whole way through, your earnings the whole way through are being concessionally taxed, and then you end up in where you pay no tax on the earnings and you pay no tax on the income. So those good decisions, those good tax savings, the flow-on effect of them is huge. Whereas as we go through the bad and the ugly here, you'll see that there's nothing but more hard choices coming down the road.
Absolutely. So the bad, onto the bad now. So the worst one of the bad that I see is negatively geared rental property.
And just to clarify, we said the worst one of the bad, there is also the ugly. So there is
There is the
worse,
ugly as well, yeah.
But I guess the bad. These are the commonly seen things where, you know, it's not, you're not lighting money on fire. It's not disappearing. It's probably just not the most effective way it's probably not the most effective way to grow your wealth. It is a way to pick up tax savings, but it's a bad way to pick up tax savings because it's not the best use of that spare cash flow.
This is done primarily for a tax deduction, I see. So I see people buy rental property.
Yeah.
And the primary reason for them doing that is the tax deduction.
Yes.
Which is wrong in any other way. I mean,
as we said, doing anything just for the tax deduction doesn't line up, doesn't stack up.
Going back to the concessional contributions to super, if I was going to put money into superannuation and that money wasn't going to go anywhere, it was going to go backwards over that period of time,
then that would be bad.
Then it would be bad. I wouldn't do it just for the tax deduction.
Yeah.
It's just that the tax deduction makes it so much more attractive because the money, if it's invested correctly, is going to grow for me.
Yeah, and that's I think what's hard about the bad, and we're probably offending a lot of people with this, using this as the example for the bad. But the point we're making here is that if you look at a negatively geared property, it's a great way to pick up a tax refund every year, but the cost to you and what you end up with in 10 years' time generally doesn't line up as good as your other options.
No, and what I want to talk about here is I want to talk about the averages as well. Yeah. So people always point out to me that
I know someone.
They bought this $100,000 property and it's turned into $500,000. Well, if we want to play that game, I can name any number of 1,000 companies around the world that have done multiples of that.
That's right.
So what we're talking about here is the averages.
Yes.
And we're not saying that rental property doesn't work for people. Yeah. Not at all. Yeah. Not at all. I've seen it work for people. Yeah. Usually what you have to do is really, really gear up. Yeah. Which I don't know. I question if that's the best. I mean, we are called Money Over 50. Yeah. So I question if that's the best way to make money. Yeah. When you're over 50, if you're in your 20s, arguably, you can borrow and buy a rental property and then borrow and buy another one and borrow and buy another one and you could use all of that potentially to get ahead, because if you get the market moving, right, leverage into anything will compound the rate of return. Yeah. Either way. So if it's going to go backwards, and it'll compound that. If it's going to go forwards, it'll compound that. But that's what we're talking about here is averages.
Yeah, and that's the I think we did a podcast. I can't remember the exact title, but it was basically saying what you don't want the possibility of a huge amount. You want the best, the most likely outcome that you're going to be happy with. And
exactly. So
if you're over 50, you don't want to be gearing up to the eyeballs and borrowing a heap to invest in anything. Like, it's not just property. You don't want to be gearing up, a huge amount to try and pick up an upswing in the market. You just want a strategy that, on average, is going to work over 10 years because you've only got 10 years to go.
Yes, and here's this example that I'm going to give right now. I think highlights the misunderstanding of what a tax deduction is. Yeah. So the example that I'm going to use, quite a simple example. I have a rental property. It brings me in rent of $30,000 for the year. I have expenses, including the loan interest, because I'm assuming, of course, that I have to. You have to assume that they've borrowed to buy this. So I have tax deductible expenses, which would be maintenance / depreciation, rates, insurances. What have I left out? Loan interest.
And this is one of those ones where, again, I feel like with this podcast we keep referring to other ones, but we've done many other podcasts about the real costs of owning property.
So, the big ones are depreciation / maintenance. Yeah. We have rates, we have water, we have insurances, and we have interest on the loan. Yeah. So whatever I've borrowed to buy this property, we have interest on the loan. That's all a tax deductible expense. So let's assume the rent's $30,000. Let's assume that all of those expenses come to $50,000, including the interest on the loan. Yep. What happens is that I'm negatively geared to the tune of $20,000. So here's misunderstanding number one. what a lot of people think before they enter into this is that they're going to get back that $20,000 as a tax deduction.
Yeah.
But that's not the case. What actually happens is that they get back their marginal rate of tax multiplied by that negative geared amount. So to flow that through, rent comes in $30,000, expenses go out $50,000.
Yeah.
I'm negatively geared to the tune of $20,000.
Yep. So your taxable income is reduced by that $20,000.
That's correct. So if I'm 39% tax rate, I actually get a tax return of 39% of $20,000. So it's $7,800 of tax return. So what I look at now is I actually have two sources of income coming in. I have the rent of $30,000.
Yep.
And I have a tax return of $7,800. So I have $37,800 coming in. Still have the same $50,000 going out. So my out of pocket is $12,200 for the year. Now a lot of people would listen to that and think, oh, I can afford that. It's only going to cost me $1,000 a month to run this property. Multiply that by 10 years, my total out of pocket is $122,000. Yeah. Now that takes the shine off any capital growth that I get over that period of time. I need significant capital growth from that property. Let's even assume, for argument's sake, that I sell this property for a $300,000 capital gain. It's cost me $122,000 along the way to do that. So I have to subtract that.
Yeah,
I get hit with capital gains tax. I get hit with real estate costs. I get hit with all those types of things.
Yeah.
So all that takes the shine off my capital.
Yeah,
and
that's
growth.
I think the point here is that the reason this is in the bad and not in the ugly is that there are, that you may be better off having done that than not done it. It's probably, I'm sure that would be better than taking that money and blowing it on overseas travel every year.
No question.
But what we're suggesting is that it's probably just not the best use of that spare cash flow, of that $12,200 every year. And that's something we look at with people is that when we've got new clients who come in and we're comparing, should they keep or sell their existing rental properties, and we've done, again, another podcast about this, is that the first thing you look at is, are they already maxing out their concessional contributions to super? Because if they're not using the good tax deductions, then that's a real waste, because they're doing something that may or may not pay off in the future to pick up a tax deduction, whereas they can be doing something that definitely will pay off in the future and get the same tax deduction.
Absolutely. Yeah, because that $20,000 could actually just go into their superannuation fund. They get the same tax deduction for that. Yeah. Assuming they fit under their concessional contribution caps. Yeah. It's in a tax-advantaged environment where the rate of return on that money is
no
lower.
Capital gains to pay on that in the future.
No capital gains tax to pay on that in the future. Again, if it's in the right asset. Yeah. And I'm getting it into exactly where I want it to be for the future, remembering that when I turn 60, I have the $1.6 million per person, $3.2 million per couple that I can actually effectively move into a 0% taxed
environment.
Inverted air quotes, a tax-free company, called a superannuation income stream or an account-based pension in retirement.
Yeah. Yeah, and that's, I think, the point, like we're saying, the flow-on effects there is that to just compare contributions to super, it's the reason why we say it's the good is because it's not just a tax saving now, it flows through into that tax saving on the earnings in future years and then into that tax-free environment when you're retired, whereas a negatively geared property, you pick up the tax saving in this year, but you're reliant on that asset. You're hoping that asset goes up over time and you're hoping it goes up by more than what your out-of-pocket cost is. And then you're also, it's not concessionally taxed on the sale of that asset. It's not, you then have to try and, if you want to get that money in a tax-free environment, you then have that. So that's kind of what I meant where you make those, you make the good tax deductions. It tends to just flow through and everything then becomes easy in 5 years' time, in 10 years' time. You're picking up more and more tax savings along the way, and it's just making life easier and easier. Whereas things that might be, the bad is that you pick up a tax saving, but then you're left with a problem in a year's time. Of what do I do then, or what do I do in 5 years' time, or 10 years' time?
You are, and there's always a debt associated. I mean, to make significant money again in most properties, you have to multiply that. Yeah. So it's not enough to do it once. You have to do it twice or 3 times.
Yeah, and that
which
then
brings
gets
into play debt.
Yeah,
and so at any given point in time, you're always worried about when do I want to
get out.
When am I going to be forced to retire? When am I going to voluntarily retire? Mm-hmm. I've got to do that, and I've got to subtract that debt off the bottom of that at that point in time.
Yeah.
The ugly. So the ugliest form of tax deduction that I've seen is salary packaging cars.
Yep.
I'm not going to say, so just a point of clarification, if you're a business owner and you have a tax deductible car or you have a tax deductible ute or something like that, we're not saying that's a bad thing. Not at all. What we're saying here is that it could be a bad thing if you do, if you buy twice the car that you needed or twice the vehicle that you needed.
This is the point. Is you've got to remember that if you look at what you're doing here is you're basically buying a depreciating asset, and that's fundamentally what's going on. Is that you might be using pre-tax money to do this. You might be picking up a tax saving, but you are buying, like we just said before, you're spending $1 to get 50 cents in future. That car is never going to be worth more money in 10 years' time.
I'll give you an example here. So, and what we're talking about is salary packaging cars. So I'll back up a little bit. Ordinarily, if you're not using something for work-related purposes, it's not tax deductible to you. However, salary packaging vehicles has a tax deductible element to it if you are using it for private use, if you salary package a car. Now, people get that so mixed up, and they think this car is either free or it's significant tax deduction that I'm getting if I'm salary packaging. What we see is that in limited circumstances, salary packaging a car can work out to be a slight tax deduction. However, it's almost never applied appropriately. So if you were definitely going to buy that car and you were going to pay cash for it and you had the cash there to pay for it, in limited circumstances, I still don't like it. But in limited circumstances,
you might be better off.
You could salary package that car, and part of the repayment and part of the running costs would be tax deductible. It's a very small proportion, which we'll go through in a minute. And you could arguably then take that money that you're going to spend on that car, and you had saved and put that to better use. Almost no one ever does that.
No.
So what people do is they either enter into the salary packaging arrangement for a vehicle because it's tax deductible. They end up buying a car that's twice as expensive as the one they were going to do because it is tax deductible. They also forget about the balloon payment at the end of the term. And what I'm talking about there is that if your car is worth $70,000, it might have a 4-year lease term with a 30% balloon payment at the end. So what that means is that if you want to buy the car at the end of the 4 years, your balloon payment of 30% is $21,000. So you have to still owe $21,000 on the vehicle after 4 years. What I see is that a lot of people forget about that. They actually don't take that into consideration. So the end of the 4 years rolls around. Their $70,000 car is suddenly only worth $21,000. They sell the car, pay out the debt, and they re-enter into a new lease agreement. So they're continually in finance. So here's the example, because I thought...
Sorry, man, just to clarify there, because I think you sort of you touched on it, but I think this is really one of the big keys is that people end up buying a significantly more expensive car. This is just human nature, that it's for the same reason that it's harder to pay cash for something than it is to tap a credit card. It's that hurt is right there. If you've painstakingly saved $20,000 and then you go, oh, my car's broken down, I need to buy a new car. If you're paying cash for that car, if you have to go into your savings and get that cash out, it really hurts. You feel every $1,000 of extra of more car that you're getting. So when you're looking at then, do I need the $18,000 car or the $15,000 car, you think how hard it was to save that $3,000. You think how hard it's going to be to save it back again. That dynamic is taken away with salary packaging because it flows through to becoming, well, a car that's $3,000 more expensive, it's only a few dollars a week. I just won't, it's fine.
There's a whole sub-industry set up
Yes.
to capture this money as well.
And that's
it's the vehicle finance industry.
Yeah.
And dealerships, they all have a department now, which is the salary packaging / vehicle finance department.
Yes. And they're designed to make that pain be as far removed as they can. The further you can kick that can down the road,
they always give you weekly figures.
Yes,
instead of a monthly, because the weekly figure seems less.
Yeah. I've even seen a daily figure.
Daily figure.
This car will only cost you this much per day.
Yeah.
You can break that dollar amount down to be so small. You kind of go, oh well, that's not that much. But that's exactly it. You never hear of someone, or very rarely hear of someone paying cash for a car and going and thinking they need a $20,000 car and ending up with a $40,000 car. It just doesn't happen.
It doesn't happen.
But we see it all the time with vehicle finance, whether it's a car loan or salary packaging, as in this case. People end up with twice the amount of car that they need, and the danger is that the first point you made is that they're doing it because it's tax deductible.
Yes,
they can also kid themselves that, well, I've spent $40,000 instead of $20,000 on this car, but it's tax deductible. No, you've just spent $20,000 more than what you needed to.
Yes, exactly right. It's a good point. Thanks for elaborating on that, because that is the big one that we see. Yeah. Because the vehicle financing department and every dealership will give you the weekly figure, and then I'll say, hey, if we salary package this, it was going to cost you $200 a week. Yeah. Now it's going to be tax deductible. You can get so much better a car for $200, the same amount, or they'll even moderately increase it to $210 per week after stripping
they'll
the
push
tax
out the lease term, or they'll do something to make it so that weekly amount is
bigger.
Yeah.
So here's a real life example. So a prospective client who is becoming a client came to me with a lease plan already in place, and we tried to get out of it because what we wanted is that money to flow into we want more to flow into his superannuation fund. We're unable to get out of it for another 2 years, so he's stuck with it. But here's how it splits up. So basically, they take a deduction from pre-tax dollars, which is the tax deductible component of it, from his pay every fortnight, and they take a post-tax deduction. What they take from his pay, they do this in fortnightly amounts, but I've just given you the annual amount just to avoid having so many figures. It's $11,000 per year that they actually take from pre-tax dollars. So basically, what that equates to is that if he was to receive that as pay, he would only get $6,710 in the hand of that $11,000 because he pays 39% tax.
Yep.
So his total tax saving is $4,290. So remember that figure, because that's the total tax saving under this whole scenario. Mm-hmm. So what it really costs him, forget about it costing him $11,000. That's pre-tax dollars. It costs him $6,710 of pay. Yeah, that's what he would receive as pay.
So that's just the before tax portion.
So that's the before tax portion. Then there's the lease plan after tax amount, which is $15,000 per annum. And that's simple. That's a $15,000 in the hand cost to him because it's the same. So basically, his total wage is reduced by $21,710 under the lease plan. Now, it includes everything, and this is another bit of a trick, really. Yeah. So it includes fuel, servicing, tyres, repayments, rego, insurances. It basically includes everything. Now, people love that. And I can understand that. They love the package component of it. This won't cost me any more. You just recognise you pay for that. Yes. You pay for that. You pay for that insurance. It's a little bit like insurance. Yeah. So the total out-of-pocket cost is $21,710. Just going through that again, it's the $6,710 in the hand that he would have received on the. This is confusing, this part, but that's the pre-tax amount that they take from his wage. It's $11,000. That would translate into only $6,710 in the hand if he took that as income. Mm-hmm. And it's the $15,000 that they take from his after-tax wage. So those two amounts together, $21,710 per year for this vehicle. It includes fuel, it includes servicing, it includes tyres, repayments, rego, insurances, all those types of things. So we worked out that if he fully owned this vehicle and he wasn't on a lease plan, so if he paid cash for it, if he fully owned it somehow, then the total yearly cost would only be around $10,000.
Yeah.
And that's allowing for $1,000 for registration, which is overs. It's a little bit less than that. $1,000 a year for insurances, and tyres and servicing $2,000 a year. Any repairs would come under that. And then the kilometres that he does, fuel's about $6,000. So it's about $10,000 it would cost if he fully owned that vehicle. Now, here's the trick. There's zero tax deductions to that.
Yeah.
It's costing him $10,000, zero tax deductions. In the other scenario, he sees that he gets a $4,290 tax deduction.
Yeah.
However,
he's got to spend
even after factoring that in, it's costing him $21,710 out of his wage. Now that's factored in that $4,290 for tax deduction.
No, that's right.
So we'd have to gross that up if we didn't factor that in.
Yeah.
But it's effectively costing him $26,000
to pick up a
$4,290 tax deduction.
Yeah.
Compared to if he fully owned the vehicle and wasn't on a lease plan, it would cost him only $10,000. Now, the opportunity cost of having only $10,000 repayment versus $21,710 that he's making now,
it's huge.
He could have that $11,710 a year difference going into his superannuation fund, which he can claim a tax deduction for as well. So there's a different way to look at it.
Yeah.
I'll make a statement here. There is no better way to own a car than to fully own the car and keep it for as long as it will run.
Yeah.
I'll refer you back to a classic podcast of the Money Over 50 podcast.
One of the early best.
Drive a $15,000 car to draw an extra $717,000 in retirement.
Yeah.
Go back and have a listen to that, because that sort of highlights over a 15-year time frame. If you drive a less expensive car, the power of having the repayments that you could have been making to the more expensive car go into your superannuation fund, and how much better of a lifestyle you'll have in retirement as you approach retirement there. So,
and that's this is, like we said, the great example here is that. That's the comparison, really. It's like, what else could I do with that money? It's not, you can't just look at something and go, oh, well, I pick up a tax saving of $4,000 a year. Yes, but I have to give up $26,000 to get the $4,000 saving. Yes. And what am I left with in 5 years' time is I'm left with a 5-year-old car.
Yes.
So I've spent $1 now to save some tax along the way to be left with, an asset that's probably worth $30 in 5 years' time. So it's just this is the key when it comes to the car thing, but it's the key when it comes to all these tax deductions. You've really got to think about, we all want to save tax and no one likes paying tax, but where is this going to put me in 5-10 years' time? And what is the best way to end up in the situation that I want to be in and do that in the most tax effective way? Not just to look at it and go, how do I minimize my tax in this financial year?
Absolutely. And it's all the way you think about it, because so many people put the tax deduction as the primary reason for them doing something.
Yep.
But it can never be the primary reason.
No.
So just a quick recap before we wrap up, because that's been a long podcast, obviously. So the good, it's all pitched around claiming a tax deduction on the way into super, turning $1 into $2, and getting it back tax-free at some stage in the future. So number one, concessional contributions to superannuation, reducing your tax from 34.5% or 39% down to 15%. Number two, the carry forward concessional contributions. We use the capital gains tax example. Number three, when you've got the money into superannuation, you're paying a 15% rate of return or earnings taxation versus typically 34.5% to 39% if you had that money invested outside in your own name. Number four, franking credits, not just a great racehorse name. Number five, the 1.6 per person, $3.2 million per couple, 0% taxed environment after turning age 60 and being retired. Your superannuation can go into that environment. So
that's the good.
That's the good.
The good is turning $1 into $2 and doing it in a tax effective way.
Yes.
And the bad, so a negatively geared investment property, what we're talking about there is turning $1 into $1. probably in future. We're turning $1 into $1.10 or into 90 cents, maybe, depending on what markets do.
That's right. Or even turning $1 into $1.50, but having to strip out 35 cents.
Yes.
Because that's what it costs me to hold it each even after factoring in the tax deduction along the way.
Yep. And then the ugly.
And then the ugly
is turning $1 into 30 cents.
Turning $1 into 30 cents.
Yeah.
Buying a more expensive car.
Yeah.
Looking at it from a tax deductibility point of view. First, which is a mistake.
Yeah. And there's a lot of these things when it comes to the car is a great example of one where you really, if you want to buy that more expensive car, don't even. I'm probably a bit of a stickler with this with clients when they're talking about buying more expensive cars. We're not even talking about tax. We're just let's just firstly talk about can you afford to buy that car, and will you get as much enjoyment out of the cost of what that car is going to be as what you could have in other ways if you'd been saving more and having more to spend in retirement, or if you'd been using that money in other ways along your working life. The first step there is, can you actually afford it? If you can't afford to do that and still do all the other things you want to do, we're not even going to bother talking about the
exactly. And I think it's a fair
assumption,
assumption, Dallas, that anyone listening is worried about their retirement somehow.
Yeah.
Like even if they think they're on track and they're only 10% worried.
Yeah.
There's a range between there's some sort of constraint, there's some sort of worry, there's some sort of concern, there's some sort of wanting to enhance their retirement savings. So I think it's fair to assume that almost for everyone listening, it's and we include ourselves in this, we just cannot justify driving a more expensive car for the cost of being able to use the difference.
Yes.
And put that money into our superannuation funds and have that grow for us. Now, the secondary benefit of that is the tax deduction that we get to do that.
That's right.
And the tax-free nature of it in the future and the tax advantage rate of return. So I think it's a fair assumption to make. It just cars we cannot stand talking about cars, can we?
We can't. And it's one of those things where you get, for some people, if they are just obsessed with cars and that's what they're into, and I met with a client the other day that he's a cattle agent. He spends 20 hours a week in his car, and that's what he does, and he really, and that's, you're then getting into the territory where you go, if that's more important to you, and having a nice car is more important to him probably than having a nice home, because he spends almost more time in the car than in the home. But for 99 people out of 100, then they are generally not making that choice to buy the more expensive car. What happens is the tax deduction thing just sneaks into their brain and skews that decision in a way where they can kind of kid themselves that, it's tax deductible, it's okay, I can afford to, it's only this much per week because the finance guy told me that, and away you go. So that's the point here, is that unfortunately we're here to be the bearer of bad news and tell you it's not that easy. There is a real cost to that, and you are turning $1 into 30 cents.
Yeah, absolutely. Good place to wrap up. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.